Mark, you touched on the fact that most money is chasing core. If we focused on assets that were not core, that may require some capex, have some leasing risk, what does the future hold for those assets?
Okay, look, the majority of money, as I just said, is chasing core. The difficulty there is actually unlocking those opportunities, so I think that'll become quite frustrating. So I think the opportunity really is what I call core plus, and those assets that have a reasonable lease expiry profile, probably a WALE of about 3 to 4 years, which will obviously cover the period before we see a recovery in the leasing market. I think they're probably the ones to be chasing. They'll also provide a better yield. We're probably looking at about 125 to 150 basis points better than the prime market. I probably still feel there's still quite a bit of risk associated with what I call opportunistic properties, which are the poorer quality properties with large vacancies.
And you think these opportunities are readily identifiable?
Well, yeah, I do. I actually think we cast it between prime and secondary, and careful with secondary, because I see secondary, there's two classes in that secondary market. But I do think in the what I call non-core, probably around 7.5%, 8%, I think this year there's going to be some good opportunities.
Thank you, Mark. Over to you, Chaz Keogh. You look after the office service business here in Victoria. If we had a look at office supply, but up against that, what's office supply and the tenant profile currently look like?
In terms of, well, just quickly on supply, obviously there's two things that are gaining significant coverage in the market at the moment. Firstly, backfill space as a result of some major commitments from the likes of ATO, Commonwealth Bank, Medibank, NAB. The other is a sublease market, where our analysis shows that there's in excess of 80,000 square metres of sublease space currently being marketed in the CBD. That said, it is challenging and volatile, and if you exclude those with a lease maturity falling within the next 18 months, that reduces that figure by in excess of 20,000 square metres.
What's inquiry like, Chaz, if we compare this time to last year?
Well, I think right now we're seeing a normalisation of the inquiry, but the hard facts is Q4 2012 versus where we are today in Q1 2013, we've seen a 50% increase in the median size of inquiry, plus a 40% increase in the number of inquiries.
So that's the positive news up against the fact that in reality we have a variety of supply in the market, including this sublease. But you were suggesting with the sublease that it has a volatility about it such that it is a fairly large number now, but it could also reduce dramatically?
It can enter the market, I suppose, as quickly as it can be withdrawn from the market, whether that be from a business strategy point of view, growth, internal growth, a new contract.
So what does all this mean for rents and importantly also incentives?
I think from a face rent perspective, it's very much slow and steady growth going forward. We're still going to see some very much market-leading rentals in some prime assets in the Melbourne CBD. From an incentive point of view, I think we're near the top of the market, but we're not quite there yet.
Okay, we get the impression from what Nick and Stephen have been talking about that organic growth will take us so far, but there may need to be political change, there may need to be infrastructure-led initiatives to help the economy kick along. Noting you can't answer or solve those problems, if you were picking a time to gear up into the future, what does the expiry diary look like going forward? Where would be the sweet spot for clients to be thinking about?
I see the recovery for the Melbourne market falling in that 2014, 2015 timeframe. If you look in the next 24 months, there is potential demand of in excess of 600,000 square metres. I suppose from a new development perspective, the sweet spot falls between 2015 and 2018, where there's 19 major occupiers who have in excess of 10,000 square metres with a lease maturity falling in that 2015 to 2018 timeframe.
But whichever way you want to look at it, 600,000 over 24 months, that should mean there is some activity of sorts occurring.
Yeah, I'd say it's the light at the end of the tunnel. There's a potential opportunity there.
Okay, thank you, Chaz. Moving on to Chris O'Brien. Chris, we've discussed this before, but we'll share with the audience. You were in the imprecise science of valuation, but you've moved to the dark side of agency. You now look after the industrial investments team. There is support, we're hearing from Nick and Stephen regionally, that industrial has greater or more positive signs than other sectors. But what's really happening out there from what you're seeing?
I think, Ari, when you talk about cycles in relation to industrial, you need to really split the categories into prime assets, secondary assets and probably C-grade assets. Simply put, in the market at the moment, with the way JV vehicles are operating and groups' motivation to build and hold, there's just not enough stock coming on the market to satisfy the level of demand. It's a situation that was really occurring in 2012 but has gained further momentum in 2013. So the activity's only got stronger, but the stock still isn't available to the public to buy. I think the sleeper in the pack, Ari, is going to be probably the B-grade stock. So from a B-grade perspective, you're talking about a warehouse that was built 1990s, maybe early 2000 with a sub-5-year WALE. As market sentiment's got a lot stronger, there's a number of investors saying, you know what, I don't feel like playing in that sub-7.5% space, but at 9.5%, this asset, with a bit of leasing risk but sound property fundamentals, makes sense. So I think that's going to be the big mover in 2013, and I wouldn't be surprised if we see 100 basis point compression in that market. Simply put, that's going to put this probably gap between prime and B grade. It's going to start to narrow, which hasn't been the case for probably, I would say, 3 or 4 years. In saying that, it's not all optimistic. The C-grade market, so your 1960s sawtooth facility with a 2-year WALE, you can't just slap that in front of an investor and say, geez, look at this, buy this, it's 13%. It needs a good story. You need an exit strategy, and it needs something that's, maybe it's underpinned by high underland value or something, but you can't simply just go high yielding, this makes sense. So it's getting better, Ari, on the C-grade stock, but it still needs a good story at the back end.
So you can't escape your valuation, Rupes. Where are prime yields going?
Okay. Well, it's not so much prime yields. I think super prime yields. So I won't be surprised if we see a sale this year of a sub 7%. I will say that with a qualification that it will have to come from a group that's more IRR driven. So they're looking at something of a 15, 20-year lease, but really strong reviews. So they're not as worried about the initial yield position. That's what it's probably going to have to take to get a sub 7% this year, but I won't be surprised if it happens.
Chris, you've touched on the supply equation at the moment being influenced by joint ventures and perhaps a lack of stock making it to the open market. If we look at leasing activity and generally deals that are occurring in the market at the moment, what does this all mean for land values and land sales?
Yep. Well, I guess if one good thing came out of the GFC, it was probably that we all stopped, took a breath and stopped building. So we probably corrected the oversupply situation that was occurring in the industrial market. That's, of course, kept vacancy rates fairly healthy, and as Stephen noted earlier, rental growth has been pretty prominent the last probably 12 months. So it's been a good story from that perspective, and it was probably the GFC that industrial needed to happen just to correct those issues. The tenant demand, Ari, is extremely strong at the moment. The pre-lease market is extremely competitive and very active. So what's that's now meaning is that developers are now back in the land market. So going back to your first question about availability of stock, a number of groups are saying, gee, we can't buy stock, maybe we need to build it. So there's developers now back in the market, which is only good for land values.
So you're thinking towards the back end of this year?
Yeah, I think the back end. I don't think Q1 and Q2 is where you're going to see noticeable land increase. I'm talking about large parcels here. Retail land's probably starting to get a bit of a kick now, but I think back end of this year, early next year, we're actually going to finally see some land value increases.
Thank you, Chris.